What's up, everybody? Welcome back to the Dent to Invest podcast. We have returning guest Tony Hammond with us today. After Tony's last podcast, all about income protection, which really popped, actually, I've decided to get Tony back again today to talk about one of the other skills in his repertoire, which is mortgages and specifically buy-to-let mortgages. How are you, my friend?
Brilliant. Thanks ever so much for having me back, James. Yeah, really good. Thank you very much.
Oh, wonderful. My pleasure. Well, something that we're covering today, which is extremely contemporaneous and a hot topic, which is interest rates, because they're through the flipping roof nowadays. And I know that from the outside looking in, most people have the misconception that that is solely linked to the Bank of England base rate. But actually, there's a little bit more to it, which I'm super interested to talk a little bit about today. Let's start from the start, which seems reasonable. Buy-to-let mortgages, what the hell are they, and why are they distinct from other mortgages?
Yeah, sure. Well, the buy-to-let mortgage is really investment properties. So it's second properties that the landlords will rent out. It could be house shares as well, or houses and multiple occupation. All comes under the same banner. So it's distinct because it's not your own primary residential property. That's really the definition behind it. So that's the main thread. I do residential properties as well, but it's a lot more complicated getting mortgages for people to invest in and to make it profitable for them moving forward. And there's more of a minefield to go through coming up as well, because the government have regulated it a lot more, and things are getting trickier and trickier on that side. I mean, it's in the news at the moment about how trying to get the tenants out there. There's not enough stock in the market. There's a number of reasons behind that, some of which are landlords that are finally divesting their property because it's less profitable than it was because the mortgage rates have gone up, as you've mentioned. But it's just a supply and demand issue as well that's causing people a lot of problems. And it's about doing it properly, because there's a lot of bad press about rogue landlords out there that give everybody a name, and there's some scams around that. I was listening to Radio 4 this month about how there's some scammers doing that. If they don't go through a proper lettings agent, they can really catch a cold. So it's a bit of a minefield, but it's an interesting one. And it's a one, I think, for me, investing in property is not a short-term investment. It's medium to long-term. If you're looking to make a quick buck in a year, I don't think property is the right thing for you to do. But certainly long-term, because you just look at, the circle of property. You have the sort of the boom and the bust, what we had in 2008, where properties sunk. But of people that stuck in there, the prices have gone much higher than they were then anyway. So it affects, as far as the economy is concerned, about how much the capital growth will be. But there's a massive demand still for renters, even more so than there was probably even a year ago, I think, because it's such a difficult, because there's just not the stock on that side of things. So that's a big part of it. But you mentioned the interest rates, as I think where everything started to go a bit wrong. And this is not political at all, but I don't think many people disagree. If I can use the phrase, when Liz Truss chucked a hand grenade in, and the markets went balmy, that was really because the markets were uncertain of what's happening, and the financial markets want stability and as much certainty as they can get. And the reason the rates went up is because, as we know, inflation's gone through the roof. And one of the main ways that the Bank of England try to keep hold of inflation is by interest rates. So if inflation goes up, they put the interest rates up as well to try to curb that spending, to bring the inflation down. And that definitely works, but it has a knock-on effect as well. And then with I think because the markets were surprised or caught cold by the hand grenade as such, is that there was a lot of nervousness. And what it was around is that it's not just the Bank of England base rates, as you touched on. It's the swap rates, which are how the banks, the mortgage lenders, really how they borrow their money. So if they're going to lend you £1 million, they want to hedge that to cover their bases. And it's really because that was uncertain. Then the swap rates went right up, and that's what's really been affecting the market since then. So it's really interesting to watch. First time it's happened for a long time, that we're seeing that the Bank of England are increasing the Bank of England base rates, and we're 4.25% now, and it's gone up many a percentage point. And yet, over the last few months, the fixed rates are starting to come down again. And you think, well, why is that? But that's mainly because of the swap rates that I mentioned that the lenders borrow their money from. So clients that are on a variable rate, or the bank's standard variable rate, which is if you don't have a fixed period or a tie-in period, you'll be on the standard variable rate, which is typically 2 or 3% more than you otherwise would have been paying. That's been getting, so their rates would have gone up all the time, but people on a fixed rate mortgage are coming down, and so that the new rates I can offer now compared to 2 months are actually cheaper, even though the base rates have gone up. Completely opposite. And I've noticed today, I've just been notified Nationwide are reducing their rates even further as of tomorrow. So I think the interest rates, the Bank of England base rates, in my view, I don't have a crystal ball. I think we've probably peaked. I think if you look at the financial press, they're saying pretty much. We don't know when it's going to start to come down from that plateau that I think we're going to be on for a while. But I don't think we've necessarily got to the bottom of the fixed rates coming down, which is good news for people that are wanting to invest, especially in buy-to-let property, because that's really caught people out. Are you happy for me just to continue?
Totally. No, I'm all
yeah,
in. This is great.
I was looking at some figures which I thought might be useful to people, that looking at just 12 months ago when I was doing buy-to-lets for investors. If we just say we had £100,000 mortgage with an £800 income, and it's a higher rate taxpayer, which is most dentists, you're probably looking at around about 2%, 1.992%, which is your typical interest rate you were getting on a fixed mortgage at that time. You look now, that's gone up to 4.5%, 5%, depending where you're at. So on the mortgage, what does that really mean then? So on a £100,000 mortgage, that would have been about £166 per month. That's now more than doubled to 375. So the annual profit a year ago for that example there would have been about 3,800 for a 100,000 mortgage. That's now dropped to 1,260. So the costs to landlords have gone up massively, and they can't always pass that on. So they're looking at rate increases, but you have to be reasonable, I think is the legal term, about how quickly and how often you can put up the rent to people. And there's only so much people can take with the cost of living crisis. So landlords are in a pretty sticky place at the moment, because there's been some big changes, and the profit has drastically reduced. So it's then when the landlords are coming up to the renewal of their mortgages, I think they're looking. I've done loads recently where it's more than doubled, and you can't more than double your rent. So it's, what do they do about that? So they're marginally profitable in a lot of cases, sometimes loss making. And then when you look at, I'm sort of diving around a bit, but the changes to come for landlords around EPC, so the Energy Performance Certificate, as you may know, that in 2025, all new tenancies have to have an EPC rating of C or higher. So they're looking at the green element of it. So the insulation, LEDs, all these sorts of things. Is it a greener house rather than some of the ones that are quite often sort of an F? So that's new tenancies by 2025. So landlords have to adapt their current properties if they're going to rent them out after 2025 again, that they've got to get the EPC to a C or above. And then all tenancies, whether the tenancies have been in there 20 years, have to be higher than a C by 2028. And that's not that long. And there'll be a lot of landlords thinking, well, what have I got to do to get my property to that standard? And some of them thinking, the mortgages are now doubled. I've got all this extra work I've got to do to make my properties compliant. There's a lot more legislation in letting a property that you've got to make sure that you get right, because if you don't, you catch a cold. People may not know that little things like smoke alarms and carbon monoxide have to be replaced regularly, not just have one. And there's all these rule changes that people have to keep top on. So there's a lot of landlords out there now that are looking to sell some of the sort of the less profitable and the older properties because of the EPC changes that are coming to market. So it's a really interesting time. But I also think that longer term, property will outperform the market, so stocks, shares, every time round. But you've just got to tighten your belt, and like with any business, you've got to make sure what's most profitable for you, and you've got to change and adapt. And I think this is what's driving the buy-to-let market at the moment. I've mentioned some of the regulation changes. So the FCA, so the Financial Conduct Authority, they now have a minimum requirement, is that lenders stress their lending at 1% above their standard variable. So the standard variable rate is that rate that everybody's on if they don't have a fixed or a tie-in period. And they sort of did that around where there was a lot of repossessions going back in 2008 and things like that, where people could self-certify their mortgage and couldn't afford to pay. So there's lots of repossessions. And so it makes getting a mortgage more difficult, but it then protects the clients as well. So what they're looking at is, okay, it's affordable today, but if the interest at the end of your fixed period, the interest rates were to go up, is it still sustainable for you? Can you still afford it? So it's stopping those repossessions or reducing the amount significantly. So that's an FCA requirement of all lenders. They now have to do that. So that's for residential properties. For the guidance for buy-to-lets is even more complicated than that. And I think buy-to-let landlords have been hit the hardest, mainly because the majority of them are on an interest-only basis. And so therefore they see the biggest increase when the interest rates change. So I can keep coming back to that marginal profitability for a lot of properties now. So some of the other big changes that have happened that most landlords on here will be familiar with. So back in April 2017 through to April 20, the level of tax applied to rental income, it used to be that previously landlords only paid the tax on the rental profits after the mortgage interest had been taken out, so they could offset it. Whereas from April 2020, the rental income is now taxed before the mortgage interest is deducted. So a massive difference there. Some people's property portfolios went from being very profitable to unprofitable overnight, just on that element alone. And so the level of tax that people pay is obviously dependent on whether they're a higher rate or a basic rate taxpayer. So typically the 40% to the 40% or 20%. Obviously, there's still the higher rate. But this is then being factored. So one of the changes into the buy-to-let market, this has been factored into what they call the interest cover ratio, or ICR as it's known. And this is where, so the gross rental income, so confirmed by the valuer, so they send a valuer out if you're going to purchase a property or remortgage, it must cover the monthly mortgage interest payment by at least a set percentage. So it's got to wash its face, is the language that I use. But it varies depending on whether you're a higher rate or a lower rate taxpayer. So for a buy-to-let property, if you're a lower rate taxpayer, your mortgage or your rent has to cover the mortgage by at least 125%. If you're then a higher rate taxpayer, then it has to cover at least 145%. So it's more difficult if you're a higher rate taxpayer to get you have to have more rent to cover the mortgage sometimes. If you with houses and multiple occupation or a house share, whichever what you want to call it, you then that's got to be 170% of the mortgage. So it gets more and more difficult. And one of the other things people may not be aware of, even if you're a basic rate taxpayer, if you have 3 or more buy-to-let properties, you're considered what's called a portfolio landlord. A portfolio landlord, there's some lenders out there, they don't want to touch you anyway. There's plenty that do, but there's some that won't. But then even if you're a basic rate taxpayer, all of your properties have to be at the 145% interest cover ratio. And that's on the whole portfolio. So if they've got 20 properties, the whole portfolio has to be at 145%. So are you getting enough rent to cover your mortgage and then some, is really what it's all about. So it's making mortgages more and more difficult. And especially when you look at with the income, the rental income, like TMW are one of the big players in the buy-to-let market. They take 75% gross of your rental income and they add it on to your other income. So if it's a dentist, what they earn, the salary and dividends. And if it takes you over the 50,000, including the rent, if it takes you over the higher rate threshold, which is currently 50,271, you're on that higher rate anyway. So it makes it more difficult all the time to do that. And then alongside the interest cover ratio, or the ICR, the PRA, which is the Prudential Regulation Authority, because banks have two regulators looking after them, lucky them. They also require that all lenders use an interest affordability stress rate, which is something else that we've got to look at when we're looking for mortgages.
There's a lot to this, isn't
there is.
there?
It's not just straightforward. The days are gone where you could just go to your bank and say, I want a mortgage.
There we are. Anyway, sorry I interrupted. But listen, there's a lot to it, but it's good we know, because otherwise we don't know what we're getting into.
Yeah, and I just thought it'd be helpful to people understand. I don't want to get too technical about it, but it's just really to say that there's legislation that's making things more difficult. And if the rates rise at the end of the fixed deal, the rental income still has to cover the mortgage payment plus a buffer. And that's what the stress rate's all about. So the ICR, the interest cover ratios for taxation, the stress rates are all about affordability. So we've got to make sure that clients can do that. And that varies whether it's a 2-year, a 1 year, a 2 year, or a 5 year. That makes it's different, which is weird, but it is. It's more expensive at the moment for a monthly payment to get a 2 year than it is a 5 year. So the fixed rate,
which says that they think interest rates are going to go down, right? Basically, that's another way of them saying that, right?
Sure, yeah.
Yeah.
There's an element, and I think they certainly will in time. But you and I, when I talk to clients, it's one of the questions I'm asked a lot: do I go for a 2 year or a 5 year? Which are the two vast majority of them? There are others that say you can go for a 1 year or a 10 year, but the vast majority are a 2 or 5. It used to be quite a straightforward question. But now it's so difficult, because do you know what the market's going to be like in 2 years' time? Do you know where interest rates are going to be, especially what's been happening over the last 6 months, or in 5 years? So there's that level of uncertainty. But people don't want to be paying more than they need, or when interest rates are coming down, they want to benefit from that. But it's really trying to get that balance, which is a really tricky one for people. But there's lots of calculators out there that we use as brokers to say, well, clients say, well, I ask them how much the rent is, and they say, how much rent do I need? And there are calculators out that work that out. So HSBC, for example, all they'll look at is the rent. How much rent do you get for that property, and whether they're willing to lend. There are other lenders out there that want to make sure you have a minimum income, so you can cover voids, but others don't. So everybody's different, which makes it so complex to know what the right deal is. There's, and I'm going off on one here, but there's some other really clever bits of software out there, because a lot of people may not be aware that even the affordability criteria that lenders use varies massively. So, for example, especially if you're self-employed, so HSBC, for example, use the average salary plus your share of profits after tax. There are other lenders that take your average salary and your share of profits before tax. There are some that just look at profit after tax. And the last one, there are some, like Halifax, for example, that just looks at salary and dividends. Now, how do you know which is the best one for you? And it can be so difficult to work out. So there's a bit of software that I, as a broker, have that you put all of that in, so your client's particular circumstances and how much mortgage you need, then it goes through to the affordability of every single lender out there, or 60, 70 of them, pretty much everyone you'd want to use. and it tells me how much they're willing to lend. So for the same client, I've seen it hundreds of thousands of pounds different. So it depends on how you take your money. If it's salary and dividends, so say with the Halifax, they would pay out a lot less than for some others. If you've got a good average salary and the share of profits, because Halifax don't take profits into consideration. So it's really interesting. So if I'm sat there as a dentist that likes to invest in properties, and I think, okay, I'll get another mortgage, the world has changed. I would strongly recommend you speak to a broker, preferably a whole of market broker, so they can see every lender out there, and they have these tools available to them, because a lot don't. And you think, well, I'm not getting enough money based on this. Well, because of some of the reasons that I've mentioned, there's some really clever tools out there that can really maximize how much you can get. But there's legislation around there that says you've got, based on your rent, it's got to wash its face by that particular percentage that I've gone over. It's not straightforward, is it?
There's a lot to it, but that was full of gems, the things that you were talking about just then. So a whole of market provider is the mortgage broker equivalent of an IFA versus an FA.
Yeah. Yeah.
Basically.
So if you go into your bank, let's say any one of the high street banks, it doesn't matter, and you talk to them about mortgages, they can only talk to you about their selection of their products and mortgages. They can't talk to you about anybody else.
Yeah.
You speak to a broker, especially a whole of market broker, they can then compare that bank with everybody else's. And that really helps, especially around remortgaging, because there's a lot of remortgaging going on all the time, and that won't change because people are coming to the end of their deal. And if they don't do anything, they're going on to the standard variable rate, which is 2 or 3% more. So you can't have that happening. And there are millions of people on the residential side that are caught in that trap, by the way. But certainly if you've got a buy-to-let mortgage, at least 6 months before, speak to your broker. Don't leave it to 2 or 3 months. Because what we can do, we can look at the market, we can lock in the best rate today, and rates are changing daily, as I mentioned earlier on. Nationwide are dropping their rates tomorrow on certain parts of the product. You can lock in the rate today. Let's say your mortgage doesn't come to an end until another 6 months. If interest rates go up again, you're still locked in at the lower rate. But if they drop below where you are, we can switch you down.
Oh, okay. Nice.
It's the best of both worlds.
It certainly is.
But only a broker can do that for you. And there are some lenders out there that you can do that up to a year before, because they'll give you 6 month off. The offers last for 6 months, and then you can renew it anyway. So you can do it up to 6 months before. So you've got to be really savvy on this. Don't leave it to the last minute. The lenders, let's say that I'd look at a client's mortgage and it's best to stay with whoever their lender is. That's really easy. It's called a product transfer, and it's almost of a press of a button if all your financial systems stay the same. But what a good broker would do is look at your current provider, but then also compare that to the rest of the market. And if there's a cheaper deal elsewhere, they then switch you over. So you're always on. So all my clients are always on the best. Because I'm whole of market, I can guarantee they're on the best deal possible for their circumstances, and we make sure every time that remains the same.
Tony, I can feel your flipping passion through the screen, mate. It comes from here, bro, and it's great. It's great because it actually can be hugely impactful to people's lives. Here's the thing. Here's what I see all the time. I see people who, especially dentists, who have a little bit of cash building up in their bank account. Okay,
Yeah.
and they think to themselves, "Oh, okay, should probably do something about that money. But let me just finish this root canal. Let me just finish that extraction." Right? 6 months later, come back to it. Hey, that pot of money's growing. Should probably do something about that. But let me just complete this filling. And so the process goes on. And then eventually they get to the point where they just think, "Hey, I've heard property's good. My mom or dad told me property's good. Let's get a buy-to-let." Something like that. Maybe they've got their first house already. So they kind of just dabble in it, you know what I mean, right? Do you think there's still space for that or scope for that nowadays? Or do you think that the people who actually do well nowadays are pretty much exclusively the people who dedicate themselves to it? And what I mean is buying buy-to-let properties and entering the property market. Do you think that there's still a space for the novice to just go and buy a house and do well?
Yes, absolutely. As long as they get good advice.
Oh, okay.
Speak to a broker for the reasons that I've mentioned. You may not be aware that the changes in the energy performance certificates coming up. If you buy a house now that's compliant, but let's say the EPC is an E or an F, you may not be aware that you've got to make significant changes, could be rewiring, that to get it to the level that it needs to be.
Yeah.
You've got to look at that. So a good broker will talk you through that process. But it really starts at, have you got a deposit of 25%? That's your starting point. Any less than that, there are some available, but the return on investment's not worth it. So I would always advise my clients have at least 25%. The more deposit you have, the better the rates are, because it's based on risk profile. And it's typically each 5% bracket. So 75% mortgage will be more expensive than a 70% mortgage will be cheaper than a 75% mortgage. And each 5% you go down, it gets cheaper and cheaper, because from the lender's perspective, their risk has gone down because they know they've got the security in the property and they can get their money back if they had to repossess. So minimum of 25%, and then you can just have one property. But you're then going to want to ask somebody, well, do I have that in my personal name, or do I put that into a limited company? What's right for me? And you've probably heard the phrase of most of the clients will, an SPV, a special purpose vehicle, which is a limited company designed for investment properties. It's got to have the right industrial classifications to make that happen. Because that stress rate on that is only 125 for a limited company rather than 145. So there's lots of things to do. So yes, you can just have one property, see how it goes. Look at it as a medium to long-term investment. Think about what happens if you have a void. You haven't got tenants in. What happens if the boiler goes? Am I still going to be profitable? Have I got the money to do that? But yeah, I would definitely. I personally would still have. There's lots of people I talk to that their pension is in property, and I think long term, compared to some of the pension funds, I think if you can do both, so diversify. That's probably the number one rule of financial advice. It certainly was when I was studying. Diversify. Don't have all your eggs in one basket, but you can do a lot worse than have your money in property. And then the last point on that, sorry, just
no, it's cool. No, it's cool.
Useful, on that point of diversification. I've had many clients that they've got this great house and it's quite a big house, but rather than buy a big house, why not buy 4 small ones? Because you're spreading your risk then. You still need a similar deposit, so 25% to each one, but you can then reuse the money. You can do it up, and then a year later you can remortgage because the prices have gone up, and you can take some money out because you're still keeping the loan to value at 25%. There's lots you can do it, where if you're just stuck with one big one, I would suggest that you look at taking multiple smaller ones is the advice that I often give as well.
There we are. And one important thing to mention, if my understanding is correct, that when the property is owned within the company, then it's more tax efficient from the point of view that the interest on the mortgage is also paid pre-corporation tax, which makes it more tax efficient. If I've understood correctly.
Yeah, because you're looking at, is corporation tax cheaper than your income tax?
Yeah.
And again, I'm not a tax advisor. I can't give tax advice.
Yeah.
So I'd always I have to say this, speak to somebody that is qualified in offering tax advice, not the guy down the pub. For some people it's better, for some people not. So it depends on what you want to do with it. So I think it's a bit like it depends is the question. But because just look at the stress rates alone. The stress rate for any property in a limited company is at 125, even if you are a higher rate taxpayer. So it's 125 versus the 145. So you don't need as much rent necessarily. So you can make some properties work where they otherwise wouldn't. So it's not a black and white question, I'm afraid. It does depend.
Gotcha. There's a little more to it. As we've learned, there's a flipping lot to buy to let properties, isn't there? There we go, especially the mortgage side of things.
And I think if most people listening today just remember one thing, because I've gone into some technical stuff, and most people aren't interested in interest, cover ratios and things like that, and stress tests. It's just speak to a broker. because it is a complex world, and we can do all of that work for you and advise you in the right way.
Cool. Tony, what a nice note to end the podcast on today. Thank you so much for your time. Much wisdom espoused. Looking forward to get you back on the Dentistry Invest podcast very soon, my friend. Speak soon.
Thanks ever so much. Cheers. Thanks, James.